Good afternoon. My name is Erika James, and I'm Dean of the Wharton School. Welcome to the 10th installment of the Howard Marks Investor Series. The series was created in 2014 by an endowed gift from Wharton alumnus Howard Marks. It brings high-profile investors to campus and now to the Wharton community virtually to share real, practical perspectives. Previous guest speakers have included Seth Klarman, Stephen Schwartzman, and Bruce Karsh, who is the co-founder of Oaktree Capital along with Howard. It's my great pleasure to introduce to you today Howard Marks, who is the co-chairman of Oaktree Capital Management. Since the formation of Oaktree in 1995, he has been responsible for ensuring the firm's adherence to its core investment philosophy, contributing his experience to big picture decisions relating to investments and corporate direction, and communicating closely with clients concerning products and strategies, often through his well-known Oaktree memos. Before founding Oaktree, he led the groups at the TCW Group that were responsible for investments in distressed debt, high-yield bonds, and convertible securities. He was also Chief Investment Officer for domestic fixed income at TCW. Previously, Howard was with Citicorp Investment Management for 16 years, where he started as an equity research analyst, then was Director of Research, and later Vice President and Senior Portfolio Manager in charge of convertible and high-yield securities. He holds a bachelor's degree in economics with a major in finance from Wharton and an MBA in accounting and finance from the Booth School of Business at the University of Chicago. Howard is an emeritus trustee of the University of Pennsylvania, where from 2000 to 2010, he chaired the investment board. Currently, he is a trustee and chairman of the investment committee at the Metropolitan Museum of Art, chairs the investment committee of the Royal Drawing School, and is professor of practice at King's Business School in London. He also serves on the Shanghai International Financial Advisory Council and the advisory board of Duke Kunshan University. He is the author of several books, including The Most Important Thing, Common Sense for the Thoughtful Investor, and Mastering the Market, Getting the Odds on Your Side. Today's event will be moderated by Professor Chris Geczy. He is an adjunct professor of finance, as well as academic director of the Wharton Wealth Management Initiative and the Jacobs Levy Equity Management Center for Quantitative Financial Research at Wharton. Chris, take it away.
And thank you to all who have joined us today. It's a pleasure to welcome Howard Marks for the latest fulfillment of the Howard Marks Investor Series and our very first virtual installment, and perhaps not our last. I'm sure most of you in the audience are familiar with Howard and with Oaktree Capital Management as the most well-known manager of distressed debt in the world. He's also very well known for his Oaktree memos, and I encourage you to explore them. They're required reading in my review, and if you take my investment management classes, as something like 200 students right now know, you'll read Howard Marks. Howard's knowledge and experience in the investing world are truly invaluable to us, not unlike his contributions to Wharton and to Penn throughout the years. Earlier this year, the university announced a new gift from Howard and his wife Nancy to endow and name the Marks Family Center for Excellence in Writing at Penn Arts and Sciences. This is their second gift in support of writing education at Penn. Howard and Nancy also established the Howard Marks Professorship in Economic History and the Howard Marks University Professorship and have endowed scholarship support for undergraduates. Howard, thank you for your dedicated support of the school and all you continue to do for us to give back and support the next generation of Wharton and Penn students. And now on to what has brought everyone here today. Howard particularly would like to hear from you, and we've chosen several excellent student inquiries which have been pre-recorded. We also will save time for audience questions at the end. You can submit questions via the Q&A dialog box button, so look at your screen, which is the last one on the panel on the right side of your screen. You can do that at any point, and we'll be sure to funnel the questions to me, and hopefully we'll be able to fit as many in as we can. We'd also like you to ask you that you please not record the session, as we will be recording and making it available on the Howard Marks series website. So Howard, let's get down to it. It's hard to imagine that we were together just back on campus in February. And if you recall, one of the largest concerns that you had, about which you wrote in part in your most recent memo, was thinking about the natural business cycle. You were thinking about the election, and in fact, you made special reference to the election. And wow, how different does it actually seem now? It seems like many generations ago, doesn't it? I'd like to start by asking you about your most recent memo from last month titled Coming into Focus. Now, of course, things have drifted a bit since then, which we'll get into, but you write that Oaktree has operated under the mantra, move forward, but with caution. And we've heard about that over the years. Can you tell us a bit about how that's guided your investment strategies over the last months, and whether your outlook on the market has changed since you wrote the memo? And of course, in the memo, you wrote about thinking about coming into focus on how you think about move forward, but with caution. Where are you today?
Well, as you say, Chris, that was our mantra in the recent years leading up to 2020. I viewed the market as follows: high level of uncertainty, low prospective returns because the Fed had lowered interest rates so much, high asset prices, and risky behavior on the part of investors trying to earn a high return in a low return world. And when other people act in a pro-risk manner, we should be cautious. As Buffett says, the less prudence with which others conduct their affairs, the greater the prudence with which we must conduct our own affairs. Their risky behavior makes the market a risky place. So we've maintained for a few years now that mantra, move forward, but with caution. What it meant was we were investing. We're not hesitant to invest. We were investing every day. We were trying to be fully invested. We were essentially fully invested, but with caution. And when I say that, we are always cautious. We believe in bringing a risk-controlled approach to our risk asset category. Our asset categories are not gilt edge. They all involve risk. And we think that a risk-controlled approach is the best way to produce steady returns, which is what we aim for. So we came into 2020 with a cautious portfolio. We didn't know what would go wrong. We didn't know what would bring the longest bull market and the longest economic recovery to an end. But we thought that the markets were vulnerable to a shock. And of course, they got a shock, an unforeseen shock. When, as you say, when we spoke in February, we probably couldn't have spelled coronavirus or COVID, but we did get the shock, and the markets capitulated. The S&P went from about 3380 on February 19th to about 2230 on March 23rd. Only 4.5 weeks later, down 33.9%. But then the Fed and the Treasury came to the rescue. In mid-March, on March 23rd, the low, the Fed announced an expansion of its programs, and the market roared back. And everybody first says, well, that's a dead cat bounce. And then they said, as I did, that if you look at past cycles, the market has bounced and fallen further and bounced and fallen further and bounced and fallen. That's how you get to a bottom. But this time it went straight up. And there have been, well, it reached 3,500 around August 31st, up 56% from the low. And there's been some backing and filling, but this last week it moved to an new all-time high. So we were very aggressive in mid-March. We put a lot of money to work when the markets were under pressure and people were eager to sell. But now we're back to moving forward, but with caution. We've been managing high yield bonds and distressed debt over the last recent decades through three crises. The first high yield bond crisis was 1990, 91. The second one was 01, 02, and the third, of course, was the global financial crisis in 08. And in each of those, we saw deteriorating corporate results, falling security prices, margin calls, meltdowns, people eager to sell, and eventually panic selling, which gave us a great opportunity to scoop up bargains at the low, which we always have done. But this time, it's quite anomalous because we still have the COVID, and at the moment, worse than ever, although there's a lot of light at the end of the tunnel thanks to the vaccine. We still have an economy which is well down from the 2019 level, and yet we have securities at all-time high. I still think we have uncertainty and now we have even lower prospective returns than we did a year ago, thanks to the Fed taking the interest rate to the Fed funds rate to zero. We have full to high asset prices, and we have the reemergence of risky behavior. The point is, you take your typical defined benefit pension plan, it needs 7% to make the math work. And at a time when cash pays 0 and treasuries pay less than 1 and high grade bonds pay 2 and high yield bonds pay less than 5 and stocks are expected to return 5 or 6, you can average those numbers out any way you want and not get 7. So people have had to move into risk asset classes. It's been great for alternative investment firms like ours, but the challenge of making a decent return in a low return world exists and has moved to the forefront.
Yeah, and we're going to come back a bit later to what you write about in the memo, which is in part about risk-adjusted returns and whether we're getting paid at the right level, which changes. And of course, we know when interest rates are low, risk premia could still be reasonable. Of course, in this case, it may not be. There's been substantial student interest in today's session, Howard, as you might expect. We have several pre-recorded questions, and let's start with one from Matthew Current. What's going to happen is I'm going to play the question, and that'll go directly to you. It's virtual, but I know it's heartfelt. So let's hear from Matthew Current.
Hi, Mr. Marks. Thanks for taking the time to come and speak with us today. My name is Matthew Current. I'm a junior in Wharton, concentrating in finance and minoring in political science. In one of your previous talks at Penn, you had used the analogy of a baseball game and said that the current market cycle was in its 8th or 9th inning, but you had also alluded to the possibility of entering extra innings. So my question for you today is, what inning do you see our current cycle being in, and have we started a new game?
First person to ask that question in this cycle. I haven't given it that much thought. You know, it's unusually hard to answer that question today. We normally think that the market has a certain ebb and flow, and that the cycles are their difference in detail, their difference in the duration, their amplitude, their speed, but that certain things do tend to repeat from or at least to rhyme, as Mark Twain said. And you know, normally what happens is that we have an upcycle, we have increasing optimism, increasing risk tolerance, increasing good feelings because the upcycle is so rewarding, and rising prices and eventual excesses of valuation. And the same thing through the economy. We have excessive expansion and excessive hiring and leverage and so forth. Then things reverse, and we get movement on the downside, and we get falling prices and worse corporate results and deteriorating psychology and the switch from greed to fear, and we also get economic deterioration. That's the normal cycle, and it's a matter of, I think the best way to think of the economic cycle and the market cycle: excesses and corrections, excesses and corrections, excesses and corrections. And the a lot of the changes are endogenous. They are within the economy and within the market. This is unique because this is exogenous. It wasn't excesses of markets and economies. It was the pandemic. We had a recovery. It was basically a healthy recovery. It was a slow, gradual recovery, the longest in history, but the slowest in post-war history, and not too many excesses in the economy or even in the market. But then we had the pandemic, and the pandemic required us to close our economy in order to keep people apart and control the spread. And we had the worst quarter in history. The second quarter was down 33% on an annualized basis. So it's very hard to say what inning we're in because this is not a routine game, I guess I would say. We're at the beginning. We know we're only about 5 months into an economic recovery. We believe that recovery will last at least as long as it takes to get the economy back to its 2019 level in terms of GDP. There's some doubt now with the failure of Washington to provide support payments. There's some doubt as to whether the recovery will live up to everyone's expectations, but I think we are in a recovery. But an interesting question is we never had a normal recession. We had an artificially induced recession. Are we still slated for a normal recession, or has the entire cycle been reset? And since it's only 5 months old, do we have years and years to go? I don't think anybody can say. And the extent to which the Fed and the Treasury and the recovery rebuild people's liquidity and rebuild their willingness to consume, and the extent to which life returns to what it always has been is very uncertain. So I think we're in the second inning vis-a-vis the economy. Of course, the market being at an all-time high, despite the negative fundamentals, or I should say modest fundamentals, that juxtaposition gives me more pause. And I would say that the rally in the market is in the sixth inning or the seventh inning. But who's to say? If the economy is salutary for the next 5 years on an uptrend, the market will do pretty well. Although I do think that the recovery from the all-time lows in March has been very dramatic, and it feels to me, most of us, like the market is ahead of the economy.
Yeah, Howard, to follow up on that, it's been an extremely interesting and diverse recovery across styles and classes. One thing you read about in the memo is risk-adjusted return, which, of course, in some sense, leads us back to the academic notion of the Sharpe ratio. Of course, you can't eat the Sharpe ratio, right?
And you can't spend.
And you can't spend the Sharpe ratio, right? We need to hit a required rate of return. There are a small number of ways to get there. What's your view on whether we're getting paid at the right level today? And I love how in the memo you bring in the capital market line, so it fits right into my lecture notes. So thank you for that. That's a great one. But then one thing about that is the dispersion across sectors, which is really unusual. With growth and large cap stocks, for example, doing well, but there's still being a large number of industries and sectors in deep distress.
Well, Chris's reference to the capital market line. If you think about a graph with return on the vertical axis and risk on the horizontal axis, we have a point on the left side where at zero risk you have the risk-free rate. And that's usually 30-day bills, which have no credit risk and no inflation risk. And that's the lowest return you can get on anything. As you move up from that in risk, there should be an increase in the expected return. People shouldn't invest in riskier assets if they're not expected to be higher returning than safe assets. So the line goes at an angle from the left, it goes up and to the right. We call that a positive correlation, a positive relationship between risk and expected return. That's when that line does go up and to the right at a reasonable pace, we say the market's at equilibrium. And if all the asset classes are on the line, we say they're at equilibrium because they're in a reasonable relationship to each other in terms of risk-adjusted return. As the risk rises, the return rises, and that's only right. Nothing else would make sense. The problem today is that the Fed took that risk-free rate, which is here, it's the point from which all returns begin and emanate, and they pulled it down. And when you pull down the risk-free rate on the left-hand axis, the line also falls. Now, sometimes it falls not in parallel. Sometimes different parts of the line fall more than others. The slope could increase or decrease. That's the slope of the line is the risk premium. But the point is, I believe that most asset classes appear to be in equilibrium with each other. The risk-free rates appear to be proportional. The returns appear to be proportional to the risk, but the problem is that all returns are at a very low level. And as I said, the pension fund that needs 7 has a hard time getting it today in stocks and bonds, and most of them have given up on that and put substantial money into alternative investments with their illiquidity and their manager reliance and so forth. Now, the great question that I usually end up speaking about is how do you pursue a high return in a low return world? What should you do in a low return world? And I've come up with 5 possibilities, and I can't think of any more. You can continue to invest as you always have, and understand that the return you make will be lower than ever. You can worry about the level of asset prices, reduce your risk to cushion the blow if a correction comes, but then your return will be lower still. You can go all the way to cash, to the ultimate preparation for a correction, but then your return will be 0. And you better be right fast, because if you're in cash for 2 years and the market goes up, you may be looking for another job or new clients. Rather than risk reduction, you can go in the opposite direction. You can increase your risk in pursuit of a higher return, but is this the time to be increasing risk when there's great uncertainty as to the fundamentals, geopolitical, political uncertainty, in addition to economic? Or number 5, you can try to look for exceptions, what I call special niches, special people who hopefully can produce a good return with safety in a low return world. But those people are truly exceptional and not easy to find.
Yeah, truly, alpha should be in some sense.
That's right.
Rare.
Yes.
It's hard to find. We've spoken together when we have been so lucky to have you on campus about the use of leverage, and in some cases you railed against it, in other cases maybe not. With low yields, it might be tempting to lever a portfolio. And of course, theory would say you can move along the capital market line, either by adding capital structure to an investment, delevering, or levering it up. What's your view as a practical matter about the use of leverage today?
Well, after the global financial crisis of 2008 was really a demonstration of the effect of leverage, because the world essentially had taken mainly mortgage-backed securities, but also loans to some extent, corporate loans, and put them into leveraged entities, structured leveraged entities. CLOs, CDOs, RMBS, and so forth. And so what they did is they had internal leverage, which is to say that you could buy a highly levered piece at the bottom of the structure with an extremely high levered return, or you could buy the top of the structure where you are not participating in the leverage with a low safe return over collateralized by the junior tranches. And what happened is that when you leverage, you say, well, if this happens, I'll be great. If that happens, I'll still be okay. If this happens, I'll probably make it through. And the outcome in terms of defaults on mortgages was a multiple of the worst case that anybody had modeled. And after the global financial crisis, I put out a memo that entitled Leverage plus Volatility equals Dynamite. And, there were thousands of defaults in mortgage-backed securities because of the over-leverage. And people should understand that leverage does not make any investments better. It magnifies the gains if you win and the losses if you lose. And so I think that to make an investment better, you have to increase what I call the asymmetry. The goal in active investing should be to look for asymmetry, situations where if things go well, you'll make a lot of money, and if things go poorly, you won't lose a lot. And if you can find those, that's the holy grail. If you find an investment where if things go well, you'll make 30%, and if things go poorly, you'll lose 30%, it's not a great thing. We're looking for this asymmetry, and leverage does not produce an asymmetry. It produces an absolute symmetry. It magnifies the gains if you win and the losses if you lose. But there's one other aspect which is not symmetrical, which is it reduces the likelihood that you can get through tough times. So if there's a downward fluctuation, an unlevered portfolio will make it through. A levered portfolio may not. So I think that leverage is far from a magic solution, and most of the real challenges in economic history have come from people who overestimated their ability to live through bad times with a levered structure.
So live by the sword, die by the sword.
Exactly. And in fact, if you think about it, leverage is an example, Chris. In investing, everything is a two-edged sword, except for alpha. If an individual really has alpha, which I define as superior skill and insight, that'll help you in good times and bad. But the other things in it, like leverage, like concentration, as opposed to diversification, these are two-edged swords. They help you if the outcomes are good, but they hurt you if the outcomes are bad.
Agreed. Since your memo, we've had some innovations. And one innovation was the announcement from two companies, Pfizer and BioNTech and Moderna, of an mRNA vaccine. And, you hear in the news, people say it's never been used on humans. Well, it's been used on about 44,000 humans at this point. And also there's been a corresponding shift in value versus growth. And for the purposes of our education at Wharton, the conversation about definitions of value in the memo I thought was poignant, because there's an ongoing question about whether intrinsic value really means something and how to calculate it. And so the coverage is great. What's your view about where we're going and the fact that what has been a medical challenge and a health challenge and a trade-off became an economic one, but now we have a potential cure, or at least a preventive measure,
a solution. We have a solution, and it looks like we'll get a lot more. And by the way, I understand that the FDA was prepared to give a vaccine emergency use per mission if it was 50% effective, and these two are 90 and 94.5% effective. So this is a bonanza in terms of good outcomes. Look, I think it's always been assumed that we would get a vaccine and it would be effective, maybe not this effective. It's still going to take a long time before enough Americans are vaccinated to get the problem under control. And there's remains a question of how many people ultimately will accept the vaccine. By the way, there have been vaccines which have been required. When I was a boy, smallpox inoculation was required. You didn't have a choice. But today we have personal rights, which sometimes supersede the rights of the community, and we have the anti-vaxxers and so forth. And then we have the logistical challenges of getting this vaccine to 330 million Americans, or if you need 660 doses to Americans, and keeping the Pfizer one at minus 70 degrees Fahrenheit and so forth. And just think about the number of inoculations that have to be made. If you have a center that can inoculate 1,000 people a day, which I think is a lot of vaccination, we need 330,000 center days to vaccinate everybody. Mm. It's an enormous challenge. I assume that sometime, my personal guess is, which is worthless, is that sometime in the third quarter we'll reach a level where the disease is really under control.
A critical point.
Yeah, critical mass.
And so the corresponding question then is, are you expecting an ongoing wave of bankruptcies in distressed sectors? And it's a bit of a forecast for fiscal stimulus, I suppose, but or do you think political winds will push the natural implication of the economic challenges away?
Well, look, what we have today, you made reference to it. We have a bifurcated market. We have companies whose business models were not challenged by the pandemic or were enhanced by the pandemic. Amazon and Netflix being obvious candidates for enhancement. And they are selling at high prices, and their stocks, and they are being lauded as having a brilliant future. And then we have companies and industries whose business models were challenged by the pandemic, and they, as you say, some of those stocks have languished, and they're still down for the year. But the question is, which ones are really hurt permanently, and which ones will the negative effect be temporary? Brick and mortar retail was doing badly before the pandemic, and the pandemic has accelerated the trends. And what will retailers be worth, what will shopping malls be worth, and so forth, is an open question. Other things, cruise lines, for example, you remember at the beginning of the pandemic, cruise ships were the petri dish for infection, and most people said, I'll never step foot on a cruise ship. But I think that once it's under control, I think that a lot of behavior will revert. So, we don't know what is the outlook for retail, for hospitality, for big city office buildings. But the person who gets that right will make a lot of money.
And how about your thoughts on, and then we're going to get to another student question, but how about your thoughts on the reversion of what we think of as value and growth? A week ago, Monday, we saw something like a 5 standard deviation reversal in the traditional index spreads in a single day.
Right. Well, growth investing, however defined, has outperformed value by a lot in recent years. And this is a normal issue Sometimes the best securities do best, and sometimes the worst but cheapest ones do best. And I think, my personal definition of growth versus value is that growth stocks are valued on distant future potential, a lot of which is conceptual and unquantifiable. And value stocks are valued on current and close-in future earnings, in addition to hard asset values. Now, clearly, the growth stock aspects are what we would call speculative, and I don't use that in a pejorative sense, but conjectural, as opposed to the hard asset values and current cash flows of the value companies. And so I think that growth investing is a reflection of optimism in excess of what's applied to value stocks. And so growth stocks do great in good times, but are hurt in bad times. Value stocks, which are essentially cheaper on multiples, they don't reflect as much optimism with regard to the future. They get hurt less when optimism declines. So, for example, in 1999, I think that growth outperformed value by 2,500 basis points, and that was the most ever. But then in 2000, when the tech bubble collapsed, the air went out of the balloon of growth investing, and value did much better. And I think so. I do tend to associate growth investing with optimism, and value investing with less optimism. And I think that has a big effect on their relative performance. The other thing, though, is passive and indexation investing. Since it has been a very strong trend over the last 15, 20, 25 years to passive investing. And what that means is that there's nobody sitting in the office of the passive investment fund saying, well, is this a good company? What is the outlook? Does it merit the current price? You have a list of securities that for the passive vehicle, and when the money comes in, you buy them in the fixed proportions or proportionate to their relative market caps. And there's a self-fulfilling prophecy aspect to that, because, let's say, Chris, you and I agreed that over the next 5 years, every penny that went into the U.S. stock market would go into an S&P index fund. What does that mean? That means over those 5 years, the 500 stocks in the S&P would become massively expensive as they received all the cash flows. The oldest stocks in the market would become massively cheap because they were starved for capital. Nobody was buying them. And eventually, however, the non-S&P stocks would be so cheap relative to the S&P stocks that their outperformance would become compelling at some point. We just don't know where that inflection point is. And but I don't believe in permanent outperformance. I don't, if one asset class outperforms another for reasons other than the risk difference for a long period of time, eventually the outperformer will become so expensive that it can't keep outperforming. That's my belief. But as Lord Keynes said, the market can remain irrational longer than you can remain solvent.
Right. Another famous Howard Marks comment is, being early is sometimes observationally equivalent to being wrong.
Right, exactly.
Resilience is key. Good, Howard. Let's go to our second student question that was pre-recorded. This is from Austin Major, and it's a question about what you're thinking about during the pandemic. Let's hear from Austin.
Hi, my name is Austin. I'm a second-year MBA here at Wharton. Thanks again for your time today, Howard. My question for you is, if you were a student during this pandemic, how would you spend your time? What would you be doing, or what would you be learning? Thank you.
Well, if your existence is anything like mine, basically what it means is you have a lot of time on your hands. You're not commuting to work or school. And you're not going to restaurants, I hope. You're not going to clubs, not going to sporting events. You're probably not playing team sports. So you have a lot of time on your hands, and you should be able to read more than ever. Reading broadly, I think, is the best preparation for a business career, and especially for an investment career. It's important to read on a wide variety of subjects, and not just investment books, but you read about science and look for parallels between the sciences and investing. Read about, my first memo this year was called "You Bet," and because I had just finished reading a book about poker and the lessons of poker for investing, thinking in bets, called, that's the main thing. You can take in so much information now because of the lack of distractions, and that would be my number one recommendation.
Perfect. Thanks, Howard. I think it was Annie Duke's book, right? Thinking in Bets. And
Annie Duke, that's right. And Annie practically got a PhD in decision making from Penn until she became the leading woman poker player in the world for a while.
Yeah, we're glad that sometimes she teaches some classes at Wharton as well. So, in the interest of time, I wanted to open it up for student and other attendee questions that are coming in fast and furious. Before we do so, I'd like to hear from one more student, if that's okay with you, Howard. I'd like to hear from Genevieve Shaw. And so, folks at Wharton, can we run Genevieve's question, which is a pretty forward-looking question?
Thank you so much for taking our questions. My name is Genevieve Shaw, and I'm a JD MBA at Penn Law and Wharton. My question is, if you were starting out in your investment career today, what area of the investment world would you focus on? So private equity buyouts, public market investing, or would you stay in distressed and special situations? Thank you.
I think the most important thing is to do something that fits you. When you're looking for a career direction, the two most important things are to find something that takes advantage of your strengths and doesn't require much from your weaknesses, and do something that you'll enjoy. In particular, I think investing has to fit with your personality. And there's kind of a spectrum. My personality, I'm analytical, I'm cautious, and I have to be induced to take risk. So credit was great for me. I moved over. I spent 9 years in equities before moving to the credit business in 1978 when I was asked to start a high yield bond portfolio, which turned out to be a great use for my talents. But, to be a credit investor is to only care about the downside, because in bonds, essentially, there's no upside. A bond is issued at par and repaid at par, and you get interest in between, but the outcome is fixed at best. That's why they call it fixed income, because the outcome is the promised return if things go right. There are no different degrees of success. There are only different degrees of failure. To be an equity analyst, you have to be an optimist. I've never met a pessimistic equity investor. It just doesn't work. To be a venture capitalist, I think you have to be a real dreamer and a real optimist, and you have to see possibilities that other people don't see. So I think it's extremely important to pick a specialty that fits your skill and your personality and your essence. Look, obviously, the interest level is much higher today in private investing than public investing. The public markets are fairly efficient, fairly picked over, and few people have been able to outperform of recent years. I can reel off a list of famous investors in the past, starting with Peter Lynch and Warren Buffett and so forth. But who are the famous equity investors today? Very few, because nobody has really put together a great record in the last couple of decades in equities. It's harder because the markets are competitive, which makes them efficient, which tends to drive out bargains. 40 years ago, you could get the Moody's manual down from the shelf and try to find what we called net companies, which were companies which had more cash than they had debt. And you could get lucky and find one, and you could make a lot of money buying something that was worth a hell of a lot more than it was selling for. Today, everybody's got a computer. You can screen the whole universe for any parameter in 30 seconds, but everybody else can do it too, and which tends to have value converge with price. And it's just harder in the public securities markets to steal a march, to find an inefficiency. In the private markets, you can find things that you can find an opportunity to buy something that most people don't know about, or you can negotiate a bilateral deal, and if it's not too competitive, get a special opportunity. So I think that most people who have the choice will go into private investing instead. One thing that you might find interesting is the emerging markets are less efficient than the developed markets. You might enjoy that. The frontier markets are even more so. Bangladesh and Nigeria. There'll be great companies coming out of there, and they'll do very well. Number one with exports, but number two as their middle class develops. So that's something to look at. But I mean, I was lucky. I stumbled on some uncrowded fields early in my career, and you should look for things that are not too crowded.
Thanks, Howard. I'm going to stick a bit with the theme of international investing a bit here. And for those of you who are lining up questions, keep them coming. And we're going to have to curate them a little bit, but there's a lot of interest here. Mathaus asked the following. First of all, he says, good evening from Italy. So this is being broadcast around the world. How do you view the private debt market and its opportunities in Europe at this point in time, in light of new lockdowns and the second wave? What's your view of internationalization? It's an extension in a way of something you just said, but with a resurgence.
Well, I think that the debt markets, and especially the private debt markets in Europe, are much less developed than the U.S. Debt markets, and in particular, Europe has always been very dependent on banks for lending, and the banks are quite constrained in Europe and risk averse, which means that there is a lot of scope for non-bank lenders to drive deals that are preferential. So I think it's a good idea, and we have an active European credit solutions strategy, which we like very much. And any market which has not been exploited and picked over, we want to find these things. They're called inefficiencies. That's a big sounding word. That's an academic word. You probably get extra points on your PhD dissertation for using the word inefficiencies. I call them mistakes. You want to find assets that are priced wrong. And when I started in high yield bonds in '78, most organizations had a rule against buying any bonds that weren't investment grade. So if 95% of investors won't buy something, regardless of the price, the few people who will buy it might get a special bargain. And we did. The same was true of distressed debt in '88, and we went into the emerging markets in '98. And, this is how you find opportunity. Where do inefficiencies come from? What causes inefficiency? Mainly two categories, in my opinion: ignorance and or ignorance and bias, let's say. If if you can find an asset that not too many people know about, maybe you can steal it. Or if everybody is prejudiced against an asset class, maybe it's underpriced. A great example, when I started in high yield bonds, Moody's defined a B-rated bond as follows: fails to possess the characteristics of a desired investment. In other words, investment grade bonds, good; non-investment grade bonds, bad. And fiduciaries couldn't buy them. Mike Milken, who was a Wharton grad, revolutionized the market with the realization that you can buy risky assets if the expected compensation is sufficient to pay for the risk. And that changed the way the world looks at risk and quality. And the challenge is that today, most people will do anything to make a buck. Most people don't have the biases that I benefited from 40 years ago, but you can keep looking. And certainly the emerging markets are less developed, and the frontier markets much more so.
Howard, in keeping with that theme, there are a couple questions on China. And I'll merge them together. What do you think of the return prospects, for example, in China, where we've seen a rapid recovery and tremendous returns, even in U.S. dollar terms year to date? And do you believe avoiding China is more heavily a risk, or would you reallocate from developed markets? And of course, we now know that China A shares market has opened up. It's something like 40% of the traditional emerging market indices and benchmarks. How are you thinking, either at Oaktree or personally, about China?
Well, we're very active in China. We've been, I think, the largest buyer of Chinese NPLs, non-performing loans. We've been there for 5 years plus. We constantly do a little more. We just put a team, 2 teams in Asia, one for China, one for India. You can't ignore China. China is the second largest economy in the world. Mike Milken tells me that it's not too long till it's the first, the number 1 economy in the world. If you think about it, the U.S. has been preeminent in the world for about 100 years, but it has never had a serious economic rival before, and it does now. China with a centrally controlled government and without too much, shall we say, difference of opinion, and with a very efficient political process, can take steps and take actions and do things that we can't do in this country because we're a little hidebound. So, and of course, everybody who knows anything about China tells me that China has been using hardball tactics to advance its own interests in trade, especially. So, China is going to be a big factor in the world, and I think that you can't ignore China. Just to give you my bottom line, the way I describe it, I say that Japan and Europe are economic senior citizens, past their prime. The U.S. is a mature adult, still quite viable, but best days of the 20s and 30s and 40s are behind it. China is a teenager. Now, if you've ever had a teenager in your house, you know that it's tempestuous and chaotic and volatile, and there are ups and downs. But you also know that the teenager has a great future ahead, and that's the way I think about China. It clearly has ups and downs. It has a lot of transitions still to be made, from the farm to the city, from excess dependence on fixed investment and so forth. But it has a great future, I think.
And you're keeping it in the family.
Yes.
Okay, let's talk a bit about macro. And the way I'm going to ask this is pretty constructive. and it links a couple of things. It links your memo with some of the things you said about the macroeconomy. If you were appointed as a governor or as a chairperson of the Federal Reserve Board of Governors tomorrow, what would your top priorities be?
First of all, I wouldn't take the job because I think to take the job, you have to feel you have the answers, and I don't feel I have the answers. I don't believe in macro forecasts or the ability to have a superior view of the macro. One of the six tenets of Oaktree's investment philosophy is that we do not predicate our investments on macro forecasts because we think it's hard to get an edge as a macro forecaster. But I think that the Fed has multiple goals to control inflation, to create enough growth so that there's job creation. And I think now it seems to act as if its job is to prevent recessions and maybe to cure market dips. And now I think it's going to add another responsibility, which is to reduce inequality. So it's very hard to pursue 4 or 5 goals at the same time, especially if those goals are not all aligned with each other. I think my emphasis, if I were at the central bank, would be to not be active. I think that the Fed for the last 20 plus years has gone a long way to devoting a lot of resources and a lot of activity to preventing recessions and preventing bad periods. But I think that bad periods are important because they restore the objective view of life. I wrote in a memo earlier this year that fear of bankruptcy is to capitalism as fear of hell is to Catholicism. And if you're not afraid of bankruptcy, then you will do risky things, you'll over leverage, secure in the knowledge that if a slowdown comes, the Fed will bail you out. That's not healthy for the business world. Businessmen make much better decisions if they don't have that's called moral hazard. The belief that you can behave in an immoral or an unwise way just because you're confident you'll get bailed out in a problem. That is not salutary. And I think that I would not be riding to the rescue at every minute in time. I think that, and I also think that small recessions let off the pressure and make it less likely that we'll have a big recession or a depression. But that's my bias. So I think that interest rates have been maintained artificially low for the last 12 years, and I think that it's one thing to reduce interest rates to stimulate the economy when it's slow, but then when it gathers some steam, you should let the interest rates float up to what might be a more naturally occurring level. And the Fed didn't do that. It should have raised rates in 12, 13, 14 when the growth was strong. They tried to do it in 17 and 18 when the growth was weak, and the market rebelled in the fourth quarter of 18. And the Fed had to stop Janet Yellen's program of rate increases and substitute some more decreases to pacify the markets. So I think that would be my bias.
Almost an automatic rule in some ways.
Right. Well, just like Keynes said that you should run deficits in times of weakness to encourage the economy and create jobs. But then when the economy strengthens and you have prosperity, you should run surpluses and repay the debt. So everybody believes in doing the first, but everybody's forgotten about doing the second. And we haven't had a surplus since late in the Clinton administration, which was not in this century. We were when we came into 2020, we were scheduled to run $1 trillion deficit in times of prosperity. which is terrible because now that we instead have a recession, we're going to have a $4 trillion deficit. And we've limited our degrees of freedom.
Yeah, I remember Seth Klarman made a comment about how concerned he was about interest rate shocks when the deficit had ballooned.
Right.
Yeah, good. Howard, we're going to have time for one more, and I hope you're able to answer. It's a great one. Chital has been very patient. She asked the first question. How do you envision creating greater inclusion of underrepresented groups in the investment world within investment firms, as well as the portfolio of investments you make? And obviously, you're tracking the developments, and this is a time of rapid change, including with the social unrest and many related ideas. But also in the asset management space, there have been letters from Congress going out to portfolio managers, asking about the composition of staff and so on. What's your view of it in the industry, which has been largely, let's face it, historically dominated by white males?
Yeah. Well, look, as with many things in this country and in the world, we have a legacy of unequal participation. When I went to Chicago for grad school, 67. I remember 68 when I think the first woman showed up. And as I recall, my Wharton days in the mid 60s, I don't remember any women in it. So I don't know if they were excluded or if they weren't interested. But it's very hard to equalize, and not just women, but racially as well. It's very hard to equalize the numbers that the government might ask to see if the potential employees aren't there. And, for one reason or another, which was the chicken and which was the egg, haven't been many racial minorities and women in the investment business. I want to see it. I want it to happen. I believe that everybody should have the same opportunities. And we are actively trying to repair the representation, but we need the candidates. I was asked to. We had an ex-employee going to one of the top business schools, and she asked me to speak to the investment club. So I said I would, and she met me at the curb. She walked me to the room where the club was meeting. I walked in the room, 30 guys. So we need the women to participate. We need underrepresented minorities to participate. We have to provide the educational opportunities, especially for the latter. I think the women have good educational opportunities today. I think there's no bias in business school admissions that I can detect. But we just need to get the people who are underrepresented in and retain them. But I think that our process will be much enhanced, and fairness in the world will be much enhanced if we can bring that.
Outstanding. Howard, we're out of time, unfortunately, and I know, speaking for myself, but I'm sure for everyone in the audience, I could listen to you for many, many hours, and you've been very generous with your time today. It was terrific. Thank you so much. I know the audience enjoyed it, and I suspect many will be seeing the tape. Just a reminder that the video will be uploaded on the Wharton Howard Marks Investor Series website within the next few days. Please stay tuned for Howard's next memo. We do at Wharton, and it becomes a required reading very rapidly. Again, Howard, great to see you. Great to be with you. Thanks so much for your time.
Thanks for the opportunity, and thank you to everybody who attended. Bye-bye.
Good night.